Hi guys, good afternoon and welcome to MF Corner. I'm Pavitra Parekh and today we have a very interesting episode planned for you. You know, we speak about asset allocation and the importance of this so often on the show, right? But today we're going to take you on the other side and talk about how this is really done and the entire process that the fund manager has to put in place to arrive at a favorable mix. I'm joined now for this discussion by Gaurav Mehta, who's CIO Alternatives at SBI Mutual Fund. He's also the person who spearheaded the formulation of the asset allocation model at SBI Mutual Fund, as well as Dinesh Balachandran, who's fund manager of the Balanced Advantage Fund, as well as the Multi-Asset Allocation Fund at SBI Mutual Fund. Gentlemen, good afternoon and thank you very much for joining us and taking out the time for this show. I have a lot of questions on, what really goes into this. So Gaurav, let me come to you first on this. Take us through the process of, of asset allocation and what are the steps that you have to put in place?
First of all, thank you so much for having us. And yes, asset allocation is a very important aspect of a client's sort of wealth creation journey. I think it's probably much more important than individual stock or security selection, or for that matter, even fund selection. But when you think of asset allocation, I think it's important to break it down into two different pieces. The first piece is what we call the core or the structural asset allocation. And I think that is a function of the client's own sort of individual circumstances. For example, what their goals are, how much time do they have to attain their goals, what the risk appetite is, and so on. And I think, broadly, clients should stick to their long-term core structural asset allocation. But beyond that, I think there is another layer of what we call tactical asset allocation, because, what we've seen is that historically, you see these long cycles where sometimes commodities do well, sometimes financial assets do well. Within financial assets, sometimes there's equities that do well, sometimes it's bonds that do well, and so on. So I think our approach is to create a framework around this, cyclical aspect of asset allocation, so that at any point in time, we have some calibration of how much to be in bonds, how much to be in stocks, how much to be in commodities, and so on. And I think, different people will follow different asset allocation processes and models and frameworks. For us, we are very clear that we want to run it in a very systematized fashion. We want to run it in a very framework-driven approach. We want to run it in a very objective fashion. So I think what we've done is we've created a very objective framework around three broad pillars. Valuations, where you look at, relative valuations of equities versus bonds. A measure of market sentiment, because we know that how markets are positioned also plays an important role in deciding when to be in which asset. And the third aspect is earnings, because, for equities specifically, the way earnings pan out has a very large bearing on whether they'll do well or not. I think these three pillars of valuations, market sentiment, and earnings is what essentially drives our asset allocation framework. Happy to delve into deeper details if needed.
All right, valuation, earnings and market sentiment. And Gaurav, I'm definitely going to come to you on each of those because I know that there are several indicators which go within each of these as well. But before that, if I can just bring Dinesh into the chat as well. Dinesh, you manage the Balanced Advantage Fund as well as the Multi-Asset Allocation Fund. Take us through how integral this process really is of asset allocation, and also how often do you need to do it? How often do you need to realign your portfolios? Because this has to be a constant, effort, right?
Yeah. I mean, when you think about the investors who are essentially putting their money in these funds, these are investors who are relatively conservative from a risk profile perspective. Where if I have to think for them, it feels like they're essentially saying that we need returns that are better than what is offered in the FD space, in the fixed deposit space. So they are okay. They essentially want a little bit more returns than that, and they're okay with some risk. But they clearly are not comfortable with, let's assume a full 100% equity fund, because the drawdown in these funds at certain points in time can be quite significant. So these are literally conservative investors who want a bit of extra return, but are also mindful in terms of how much risk are they really willing to take for generating that excess return. And that is where this process of asset allocation really comes in. Because when you think about a good asset allocation, what does it offer? It offers two enhancements. One, in terms of how do you generate that extra return over fixed deposit. So there you have to sort of figure out when to overweight equities, when it probably makes more sense to be overweight bonds. And having an objective framework really helps you in terms of taking that call. So for generating extra return, for us, a good asset allocation framework is absolutely the backbone to this whole thing. And so it really comes in handy there. The second aspect, which is also very important, is again, it's not just about return, it's also about risk. And a good asset allocation process or a good asset allocation framework really helps in mitigating the drawdown risk. So a good framework should help you figure out when there is excess risk in the markets. And at that time, maybe reduce allocation to a riskier asset like equity and potentially allocate more to fixed income and vice versa. So both from a return enhancement perspective as well as risk minimization perspective, I think a good asset allocation framework is absolutely integral. And so this is something we very strongly believe in. Now, you also asked a question about rebalancing. How often do you rebalance? Now, in our framework, we have the capacity to run the model on a daily basis. But what we've seen is that sometimes there can be too much noise in sort of trying to update a framework on a daily basis because the markets fluctuate every day. And if you're going to try to overthink these fluctuations, sometimes you can just sort of get lost in the noise. So what we've decided is that under normal circumstances, we'll update the model once every month at the beginning of each month. And we've seen that is good enough for the most part. Now, what we've also told ourselves is that if there are exceptional situations where the markets move by more than 10% intra-month, in that case, we will not wait till the end of the month. We will immediately then update the model post this kind of movement and then see whether any rebalancing is needed at that.
Okay, that is very interesting to know how the fund manager works and really operates all of these funds for someone who's just been investing in all of these. Just to check again, Dinesh, this is the model that you apply for your balanced advantage fund and the multi-asset fund, right?
Yeah, so for the balanced advantage fund, we run using the model that Gaurav just described. Yeah. Which is much more sort of fundamentals based. In the case of multi-asset, because you're also bringing in gold, which is a separate asset class, and they're thinking about gold in the form of cash flow yield or in the form of a interest-bearing instrument is difficult, and so for that we've created a separate model that allows us to think about equity, fixed income, and gold in one framework. So the multi-asset fund is based on a slightly different framework.
Okay, got that. And I'm going to come back to you in just a second. But Gaurav, like we were discussing earlier, you mentioned three main parameters. That's valuations, earnings, and market sentiment. I believe all of these are also comprised of several indicators. Do you want to take us through a little bit more of a deep dive and then explain how the final readings really arrived at?
Sure. So you're right. I mean, different people have very different ways of looking at, each of these valuations, earnings, and market sentiment. I think for us, when you think of valuations, which is where I would want to begin, valuations here is a relative call between equities and bonds. And in general, you would have seen that equity valuations tend to follow bonds, but in an inverse fashion. So just to give you some context, last 18 odd months, we've seen that the Nifty has been largely flat, the Sensex has been largely flat, but corporate earnings have kept coming through. What that in turn has done is that PE multiples on equity markets have derated. And alongside, you would have also observed that 10-year bond yields in India have been continuously rising over the last 18 months. And so that inverse correlation where, when bond yields are low, your ability to support higher equity multiples increases and vice versa. So I think to model that, what we rely on is a simple spread, which is that what are equities yielding versus what are bonds yielding, and just look at that spread. So what we tend to do is we just invert the P to arrive at an earnings yield number for the Sensex or the Nifty, and then subtract 10-year bond yields from that equity earnings yield number, and that spread basically tells us which of the two asset classes is more attractive at any point in time. And then equity earnings also themselves tend to be cyclical, so to adjust for that cyclicality, we not only just look at the current earnings yield, but we also look at a 10-year inflation-adjusted earnings yield for equities, and then again subtract 10-year bond yields from them to get some sense of which of the two asset classes is more attractive at that point in time. Moving from valuations, the second thing that I talked about was market sentiment. And again, I think, this is a famous saying, be greedy when others are fearful, be fearful when others are greedy. The question is that how exactly do you calibrate the overall market's greed and fear at any point in time? And through this measure, what we've tried to do is to attempt to quantify, into one measure, the overall greed and fear of the market. And, there are obviously some more than a dozen sub factors that go into making the sentiment measure. But, if I were to give you some broad examples, these would be categories like market internals. So, for example, in a relatively defensive market environment, you see low beta stocks, large cap stocks, high quality stocks, defensive sectors do well. But that complexion changes in an optimistic market environment. So just looking at what kind of stocks are doing well, is a majority of stocks doing well or not, gives you some sense of how the overall market sentiment is. Similarly, what we also tend to capture is a lot of actual positional activity. For example, what are mutual fund flows looking like? What are FPIs doing in index futures? Are they net long, net short? So apart from market intelligence, we also tend to capture this positions, the actual positional aspect of it. And a third category would be, to capture retail sentiment. For example, what kind of Google trends are retail investors searching for? That gives you interesting insights on what the market sentiment at any point in time is. What is the extent of primary market activity? In a buoyant market, you see a lot of IPOs come through. So I think we combine 12 or a little over 12 such sub-factors into one market sentiment measure, and it works as a contrarian tool. When everyone is pessimistic, that's the time that you go in and increase equity allocation. When everyone is optimistic, that's the time that you try to reduce equity allocations. So that's the second piece, valuations, market sentiment. And the third piece, obviously, is earnings. For earnings, again, we try to capture through a model. This is where a lot of macro factors, as they are shaping up in the global sphere as well as locally in India, they tend to have an influence on corporate earnings in India. So through this earnings measure, we try to capture some of these macro variables, things like global money supply growth, durable liquidity growth, shape of the yield curve, and so on. And we just combine them to get one measure on how earnings should shape up in India. And largely, these try and take into account the impact of fiscal policy, monetary policy, and credit market conditions, both local and global, to get you some sense on where earnings are headed. And then eventually, we combine these three: valuations, market sentiment, and earnings, to get a final calibration of which of the asset classes look interesting at any point in time and by how much.
Okay, that really explains it and takes us through the various parameters that you mentioned earlier. Gaurav, thanks a lot for that. I have a lot more questions also on what the current allocation is really telling us. So I'm going to get to all of that in just a bit. But before that, we do have to take a short break. I request you to stay on. We're going to be back in just a bit. Welcome back. You're still tuned into MF Corner, and we still have the SBI Mutual Fund team with us. We have Gaurav Mehta and Dinesh Balachandran to talk about the entire asset allocation approach. Dinesh, we were just talking about all of the various parameters that you have to consider, but take us through how all of these individual readings actually translate into allocation. Say you have all of these readings, and also what happens in different contexts. Say if all three of the readings are positive or all are negative, take us through what you would actually do in terms of asset allocation once you have these readings.
Right. So as I said, normally what happens is at the beginning of each month, we have an asset allocation committee meeting. This meeting is comprised of senior members of the team across equity, fixed income, asset allocation, risk, etc. And this team reviews the readings and tries to see whether there are any other macro factors that we are not sort of thinking about from a framework perspective. And so it's actually a pretty nice in-depth discussion where we think about both global markets as well as local markets. And then finally, we essentially come out with a recommended allocation to each of these asset classes. But that is just one step of it, right? Now, what you also need to do then is also think about, okay, once I've decided on a certain weight to equities, what do I do then? Because at the end of the day, I have to buy individual stocks. So that is the next part of the journey where let's assume I have a 50% weight in equities. Now within that, what then I do is we have a very good experienced research team where we have analysts with a lot of experience across sectors. We ask for the highest conviction ideas of the analyst team and use that essentially to think about which stocks to buy within the given sort of allocation to equities. So the first part is essentially the asset allocation part, where, as I said at the beginning of each month, we decide on that, and then comes the equally important part of figuring out which stocks to buy, where there is constant discussion and dialogue between the fund managers and the analysts to figure out which stocks at any given point in time are the best ones to buy. That's basically from a practical perspective in terms of how we go from model trading to actual sort of investment in the fund. Now, with regards to the range of outcomes, the way it works is, Gaurav spoke about the three major parameters, right? If all three parameters are negative, we will go to 0% negative. In this fund, we are very clear that we want to sort of think about the entire range from 0 to 100% for equity. And if the situation so demands, if we find that all three parameters are negative, then we will have 0% allocation to equity. On the other hand, if all three parameters are positive, then we will go to even 100% in equity. Just to give you a practical sense for this, just post the COVID crash in March 2020, and this doesn't often happen, by the way, post-COVID crash, we had a situation where all three parameters of the framework were screaming buy. From a sentiment perspective, it was so negative, so the sentiment part of the framework was screaming buy. Valuations had corrected so meaningfully that it felt like this is a fantastic opportunity from a valuation perspective. And similarly, from an earnings perspective, it felt like, the worst is essentially priced in. So the chances of further downgrades to earnings is going to be very minimal. So that was a rare occasion where all three parameters essentially became positive. And the model recommended 100% allocation to equities at that point. Now, this probably will happen like once or twice a decade. So it's not something that happens every year. But if the situation so demands, we will go to either 100% equity or 0% allocation to equities. Now, then you have the intermediate sort of scenarios where if two parameters are negative, then the equity allocation will go down to 20. If one parameter is negative, then you have an equity allocation to that will be around 40%. If all three parameters are neutral, then we'll essentially go to 60% allocation equity. So depending on the exact range for each of these parameters, whether they are signaling a positive whether it's actually a negative signal, the allocation to equity can then vary between 0 to 100%.
Okay, that is very interesting to know. And, like you mentioned as well, these events happen very rarely when you would have this kind of a structure. Did it also ever go to 0% equity?
Yeah, we have situations where we've gone to 0% allocation to equity as well. So again, now it doesn't seem so possible, but think about in 2007, right? At the end of 2007, you had the other extreme where sentiments were crazy. You had valuations that were 2 standard deviation above historical norms, right? And earnings outlook was so positive that the chances of a positive surprise at that point was extremely minimal. And as I said, this going to 0 or 100, it doesn't happen often. But when it happens, it's a very, very serious signal. It is something that we take seriously. And so the rare occasions where they do happen, I think of it as a fantastic opportunity to generate alpha in this.
Okay, got that. And which is why it's good to trust your fund manager to handle this rather than, if you were trying to invest by yourself. I'm sure any investor would be, of course, not able to handle a situation like this. But Gaurav, coming to you now, we've spoken about situations where you've gone to 100% equity. You've spoken about situations where you've gone to 0. But take us through what the current asset allocation model is really telling us.
Right. So I think, as Dinesh rightly mentioned, these opportunities where you can go to 0 or 100 come very infrequently. And for the past 18 odd months, we have been in what we call an energy preservation mode, because our equity allocation, our allocation framework has basically swung from being modestly underweight on equities to equal weight over the last 18 months. And similarly, on the flip side, on bonds, it has swung from fluctuating between again equal weight to modestly overweight on bonds. So there hasn't been a very clear, decisive verdict that's come through from the framework over the last 18 odd months. And if I take you to the reasons for that, 18 months ago, the sentiment reading was very euphoric. I think you would recollect that was the time that a lot of these IPOs were coming through the market and they were getting oversubscribed, and there was a lot of frenzy around that. A lot of individual investors had taken to investing as a almost a full-time career option and so on, right? So there were clear signs of froth then, which to us was from a contrarian standpoint was a reason to cut down on equity allocation and move to modestly underweight. And then, as markets corrected, and especially through the Russia-Ukraine conflict, by which time markets had come off quite a bit, the sentiment piece took care of itself. It, erased those euphoric readings. But alongside, what also happened is that there was a flare-up in commodities, which sort of exaggerated the problem of inflation, and that in turn led to a significant surge in bond yields. And to the extent that, as I explained earlier, our model looks at equity yields versus bond yields. On relative basis, equity valuations turn very unattractive. So, which again, brought back equity to modestly underweight and bonds to modestly overweight. Now, over the last 18 months, obviously, there's been some bit of valuation normalization, but then the earnings picture has started to deteriorate because a lot of macro variables that shape earnings eventually are starting to head down. And which is why, we haven't gotten a chance to swing on either sides on allocations. So, just to give you some context of where we are today, the sentiment reading, as I explained earlier, has moderated. If anything, today that reading is slightly into the zone of what we call pessimism, which is a good development from a contrarian standpoint. But it's not pessimistic enough where, I can go out and take a very strong contrarian buy trade. Similarly, valuations, last 18 months, the markets have been flat. Earnings have caught up. There's been some PE de-rating. And more recently, over the last 45 odd days, you've also seen some cool off in bond yields. So that has made, again, valuations a bit more, a little less expensive than they were, let's say, 18 months ago. But I wouldn't say that they still are expensive, or they still are cheap on our frameworks. They even today are, either closer to averages or slight modestly expensive versus averages. So again, from there on, you aren't getting a very strong signal to significantly up your equity allocation versus bonds. And the third piece I think I just talked about is the earnings piece, where if anything, the near-term picture isn't as attractive as, let's say, it was a few quarters ago. So on the whole, the framework continues to suggest most likely, the grinding action that you've seen over the last 18 odd months could probably continue because the framework still is asking you to, follow diversification across assets rather than move significantly overweight or underweight in a single asset class.
All right, that is very interesting, and that is what the current setup is looking like. But with that, Dinesh as well as Gaurav, we're going to wind down in this edition of Mutual Fund Corner. Thank you very much for joining us and taking us behind the scenes, explaining the entire framework to us and telling us everything that goes into managing one of these multi-asset allocation funds. Thank you guys very much for tuning in, and remember to stay with us because closing bell comes up next for the final hour of trade.